Hey everyone, and welcome back. You sent in some articles about some pretty rough times for the Indian stock market lately, specifically the Sensex and Nifty indices. Some serious drops there.
Oh,
And, well, you want to know what's going on
yeah.
and why, which
Mm,
is where our expert comes in.
exactly. It's always more than just the numbers.
Right, so let's dive in. All the articles you sent India Today, Mint Business Standard, even Business Today, all reporting some big drops, especially November 13th,
Mm.
almost 1,000 points down for the Sensex and over 300 for the Nifty.
Yeah, and you have to see these drops in context. This is actually a 5-day decline.
Hmm?
Both indices now are like, what, more than 10% below their September highs?
Okay, so 5 days sliding 10% down.
Yeah.
For our listener, what does that actually mean? Is this a correction, a crash, something else?
Well, 10% drop, that's generally considered correction territory. It's a sign that the market's reevaluating things, reacting to, well, a bunch of factors. And that's what makes this deep dive so interesting, figuring out those factors,
Yeah.
global ones, stuff within India itself. Got it. Now, a lot of these articles point to the U.S., a surging dollar, rising U.S. bond yields. But Business Today specifically calls this out as the Trump effect. More on that.
It is fascinating how global politics plays into markets, right? Trumponomics is back, with Trump back in the White House. And this time, it's not just trade wars. The anticipation of increased spending, deregulation, tax cuts, all hallmarks of Trumponomics, they create this ripple effect across global markets.
So for our listener, why would a strong dollar and higher U.S. yields hit the Indian market? I think that connection might not be obvious to everyone.
Think of it this way. When the U.S. dollar is strong and those bond yields are up, U.S. investments look really good to investors globally, especially those wanting safe returns. So money flows out of emerging markets like India, goes into those safer U.S. assets. Basic supply and demand. Less demand for Indian assets, prices drop. And that means, yeah, stock prices take a hit.
So it's like a domino effect from the U.S.
Exactly.
Yeah.
A chain reaction. And this Trump effect with, potentially aggressive policies, inflation, it adds fuel to the fire. It makes that shift toward U.S. markets even faster.
Now, on top of that, we keep seeing these articles mentioning foreign institutional investors. The FIIs pulling out of India. Mint even reports a massive outflow just this month. Rupees in November alone, a staggering euro 23,911 crore.
Yeah, that's a lot. And to complicate things, India Today suggests that China's new stimulus package, it's drawing FII money away from India.
So it's not just U.S. versus India then?
Nope. Global markets are all connected. Right now, that stimulus package from China signals potential growth, which is attractive to those FIIs always hunting for the best returns. Essentially, what happens in Beijing can directly affect Mumbai.
Interesting. But let's not forget what's happening within India. The articles highlight internal challenges, weak Q2 earnings, especially in consumption sectors, which India Today points out, plus rising inflation, which Mint reports hit 6.21% in October.
Right. Weak earnings like that, especially in key sectors like consumption. It shakes investor confidence, raises concerns about businesses struggling, affecting future growth and profitability, and that inflation number exceeding the RBI's target, and it just adds to the uncertainty.
And Mint even suggests that the RBI not cutting rates is making things worse. Is there any truth to that?
It's complex. On the one hand, cutting rates could stimulate the economy, maybe help those struggling earnings, but then it risks making inflation even worse. The RBI's walking a tightrope, trying to balance these competing priorities.
This all feels like a perfect storm. Global pressures, FII outflows, internal economic challenges, all at once.
Yeah, it does seem that way.
And then to add on top of all that, a record low for the rupee against the dollar, 84.40, according to many sources.
Yeah, the rupee struggling is another big factor. A weaker rupee. It can impact a lot of things. Makes imports more expensive. Makes Indian investments less appealing to foreign investors.
Before we get into that, though, I think we should explain to our listener what a weak rupee means for them, practically speaking.
Oh, of course. So, if you're planning a trip abroad, well, a weaker rupee means your travel costs are going to be higher. Imported goods, too, from electronics to clothes, more expensive, potentially hitting your budget.
Yeah.
And for businesses who rely on imported materials, their profit margins are squeezed.
So not good news for anyone.
No, not really. And it's important to remember, this isn't just a random event. The rupee's weakness is tied to those global things we discussed, especially the Trump effect.
Right, that strong dollar, those rising U.S. bond yields. Wow, we've covered a lot in part one. Maybe we should take a break and come back in part two to dig deeper into the rupee's troubles and what our listeners should be watching out for.
Sounds good. When markets take a dip like this, it's easy to get caught up in the doom and gloom. But as we dig in, I think there's some interesting details for our listener.
I'm all about the details. Lay it on me.
Well, take those FII outflows. Not all FIIs are the same. Some are short-term. They react to every headline. Others have a longer view. They might even see this downturn as a buying opportunity.
So some are running for the hills, others are bargain hunting.
Exactly. And Mint points out that domestic institutional investors, the DIIs, they've been buying during the same period, potentially offsetting some of that FII selling.
Interesting. So it's not a uniform reaction then. Not everyone's panicking.
Right. And that highlights something important for our listener. The difference between how the market feels and the actual economic fundamentals. Short-term sentiment can swing wildly, but it's those underlying fundamentals that determine the long-term trajectory of India's economy.
That's a great point. So let's talk fundamentals. We've touched on some challenges, weak earnings, inflation, any bright spots, anything to support a rebound.
Of course, India still has major strengths. A young and growing population, expanding middle class, a vibrant entrepreneurial scene. These are long-term assets that shouldn't be overlooked.
So there are reasons for optimism, despite the current downturn.
Definitely. And if we look at specific sectors, some are resilient or even poised for growth despite the current situation. Remember, Business Today mentioned some sectors as being relatively safe.
Yeah, they specifically mentioned banking, new age, digital companies, hotels, pharma, and IT.
Right. And there's good reason for that. Banking benefits from India's increasing financial inclusion. Digital companies are writing that tech-wave hotels are seeing travel and tourism bounce back. Pharmaceuticals are always needed, and India's IT sector is a global powerhouse.
So not all doom and gloom. Some industries are ready to weather the storm.
Exactly. And this is why it's so important to do these deep dives. Look past the headlines, understand the nuances.
Now, Business Standard brought up something interesting. The interplay between FII selling and DII buying. They said that as FIIs have been pulling out, DIIs have been stepping in to buy up those shares. What do you make of that?
That's definitely worth watching. It suggests that domestic investors might have a different outlook than their foreign counterparts. Maybe they're more confident in India's long-term growth, seeing this as a chance to buy low.
Kind of a vote of confidence from within India itself. But let's be real. Even with those potential positives, there are some serious challenges.
Absolutely. Inflation is still a major issue. It erodes purchasing power, puts pressure on businesses, creates this environment of uncertainty.
And as Min pointed out, rising inflation makes it tougher for the RBI to cut interest rates and give the economy that boost.
Yeah, tricky situation. To understand it fully, we have to look at the global context.
You mean the Trump effect we talked about? Business Today suggested his return, and those aggressive trade policies, they'll likely fuel global inflation and keep the U.S. dollar strong.
Right, and that spills over onto emerging markets like India. Strong dollar means imports get more expensive, adds to those inflationary pressures, and makes it harder for Indian companies to compete globally.
So it's this whole web of factors, domestic challenges, global pressures, investor sentiment. They all feed into each other.
Yep. Analyzing markets is rarely about just one thing. It's about understanding how these various forces, often operating on different timelines, come together to shape the landscape.
It's a giant, multidimensional puzzle. So for our listener, trying to make sense of all this, what are some key takeaways? What should they remember?
First, don't panic. Market corrections are normal, part of the economic cycle. This one is significant, but it's not unheard of.
That's good to hear. What else?
Focus on those fundamentals. India's long-term growth story is still there, even with the current issues. The country has strengths that'll continue to attract investment and drive the economy forward.
Long-term thinking is key. And lastly,
Stay informed and be discerning. There's so much information out there, and it can be conflicting. Think critically about different viewpoints. Understand your own risk tolerance. Make investment choices that align with your goals.
great advice. But before our listener goes off and starts frantically researching, we still have that elephant in the room, the struggling rupee. We'll be back in part 3 to explain what that record low against the dollar really means and how it all fits into this bigger economic story. Okay, so the rupee. That record low of 84.40 against the dollar, it's making headlines and kind of freaking everyone out. Currency stuff can feel so abstract, like, yeah, it's bad news. But what does it actually mean for our listener?
Right, people get lost in the numbers. The real impact is how it affects your daily life. Think of the rupee as your buying power, globally. When it weakens, you just get less for your money, like literally less.
So weaker rupee, that means imported stuff gets more expensive.
Exactly. Everything from the latest tech to the materials companies use to make things. It all gets pricier for businesses and people like you and me.
Makes sense. More expensive electronics, higher costs for companies. But there's got to be more to it, right? Wider implications.
Oh, absolutely. Remember those FIIs we talked about?
Mhm.
A weak rupee makes them think twice about investing because their returns, when they convert it back to their currency, are going to be smaller. So it's not just about things costing more. It can also scare off foreign investment.
Double whammy hurts imports. A&D makes India less appealing to invest in. Not a good combo.
Definitely creates challenges. But like we said, it's all connected to those global things, right?
Yeah.
Especially that Trump effect business today highlighted.
Right. Strong dollar, rising U.S. yields, and maybe even more aggressive trade policies from the U.S.
Exactly. And here's where it gets interesting. The rupee being weak, it's partly just reflecting that bigger global trend. A strong dollar usually means weaker currencies in emerging markets. It's like a seesaw. One side goes up, the other has to go down.
So it's not that the rupee itself is weak. It's more that the dollar is super strong right now.
Yeah, good observation.
Right.
It's a subtle difference, but an important one. It shows how interconnected everything is. What happens in the U.S., it ripples out to markets everywhere, including India.
Okay, so global currency, tug of war, dollars winning.
Yeah.
For our listener, what should they watch for with the rupee? Any key indicators?
Keep an eye on the U.S. economy, inflation numbers, interest rate decisions from the Fed, anything about trade policy.
Yeah.
All that directly affects the dollar, which then, affects the rupee.
And what about things happening in India? Anything specific to look out for?
Watch what the RBI does. They've been trying to stabilize the rupee, but it's tricky. They have to weigh the pros and cons of intervening, versus the risk of using up their foreign exchange reserves. What they do and how well it works will be a big factor for the rupee.
This is all making a lot more sense now. We went from stock market woes to this bigger picture, global trends, FIIs, those internal economic issues, and now the rupee, all connected, like a giant puzzle with tons of moving pieces.
Exactly. The takeaway is context is everything. Don't get lost in the day-to-day or the headlines. To really get it, you need to see the bigger picture, the whole economic and political situation.
So important. It's not just about the numbers. It's about what's driving the numbers. As we wrap up, any final thought-provoking question for our listener? Something to chew on?
Absolutely. We talked about the challenges for the Indian stock market. What about the opportunities? If this keeps going, what parts of the economy will be hit hardest? And on the flip side, what new opportunities might pop up? It's in times like these, all this change, that we often see the seeds of something new.
That's a great point. It gets our listener to think beyond the crisis, to the potential for growth and change. Even in a downturn, some people find ways to not just survive, but thrive.
Right. Challenges often lead to innovation, and they say necessity is the mother of invention.
This has been a fascinating deep dive. Thanks for walking us through it all.
Happy to do it. I always enjoy untangling these economic and financial threads.
And to our listener, keep exploring. Keep asking those questions. The world of finance, it never stands still. Staying informed is how you stay ahead. Until next time, keep diving deep.